All right, workbook time. So what we've got here is a workbook. We've got two tabs here, and I can send this to everyone on the call, or if you're watching the recording, just email us. And this is adjustable, and it's also user-friendly to the client. So what I've done with the client I put this together for is create a recording showing the couple how to use it, but also the tabs that we can actually change as the user is what's shaded in this yellowish color. So I'll put that in the recording. Perhaps I put a PDF or a definitions column as well that just provides awareness around the fact that the columns that you can adjust when you're looking at this are shaded in yellow, keeping it simple then. Otherwise, it can be overwhelming if I don't have instructions. So what we've got here on the left, salary. So this was for an individual. His salary was about $1 million per year. He worked at a medical practice in which they offered him a qualified plan where he could contribute anywhere from 25 to 75% of his salary of $1 million. So that allows for large taxable deductions or large contributions, all of which can be deducted. At $1 million per year in income, he's in the highest tax bracket, obviously. Tax bracket we can't adjust. So if you have a client that earns $100,000 per year and they're in a 20 to 25% tax bracket, you can adjust that if you want. So adjustable in that respect, which is great. Let's go back to the million. So in this example, salary increase, I have it 0. You'll notice on the bottom, we've got another tab that displays a salary increase. I'll walk through that next. But if I want to keep things simple and just show a flat salary, I'm going to show that in this particular case. Side note, why it's only 10 years is because this particular couple wants to work for another 10 years. They're getting involved in real estate, and their plan is to exit the practice and just focus on real estate. So if they're going to do this with respect to heavy contributions, it'll only be for 10 years. Tax bracket, salary increase, and then contribution of salary. So here we can actually elect what the percentage is from money, whatever our salary is, to be contributed to the plan. And you can adjust this each year. So if he picks 10%, what happens? $1 million, 10% of $1 million is $100,000. If he picks 25%, there you go. And why this is adjustable is because he's trying to figure out how much he should contribute. He's attracted to the immediate tax break, but doesn't want to put too much money away because he realizes I'm 42 now, not going to have access to this for almost another 20 years. So how much do I want to really put away, especially being involved in real estate where access to cash is an opportunity cost? So let's leave it at 25%. This will be automatically populated. Account balance. This is just a compound calculator. Money goes in, 262.5 at the end of the first year, based off this column. If we adjust that to 4%, what happens? It goes down. What if you have a client that thinks they can earn 8%? That's what happens. And I like to add talking points to this. And if a client wants to put in 8%, let them put in 8%. Some people think they can do that. And then we can make adjustments after the fact. For now, let's leave it at 5%. So I see my account balance grow over time. Income after contribution. So what this represents is on the far left, you've got your salary. If you contributed 250 grand, which is 25%, that was all tax deductible. So here's the income that's taxable to you. And actually, the next two sections display a side by side. So what we've got, no contributions, $1 million per year. That's his salary. taxes due at a 40% bracket, $400,000. It's a lot of income tax. Contributions with tax savings. So if he decides to shovel in $250,000 per year, income is now $750,000, which still at a 40% bracket, because we have not adjusted the bracket. Taxes due would be $300,000. How he will view that, since he's already used to paying $400,000 in taxes, is an immediate tax break of $100,000. So I do want to highlight that tax savings there. Let's continue on. Distributions, taking the money out. What do we see? The account balance. Compare that with column H. You'll see they're identical because we don't have any distributions. Then this, gross income, taxes, and net income. So what this will do, let's assume you want to pull 300,000. Make this a little bit bigger. One too many zeros. That explains it. Okay, cool. So because we've got a 40% bracket on the far right, what happens here, 300K, taxes 120, net income 180. Now, if we feel they'll be at a lower tax bracket at this point in time, can adjust it here because this tax bracket column will have an impact on the income piece. There we go. Also, one other adjustment you can make if you'd like. So this is shaded in gray at age 60. The reason why is because if it's a qualified account, that's when I'm going to have access to it without penalties or other stuff. If you want to adjust the interest rate that you're going to apply to that account balance, we can do that. So maybe we adjust it to 4%, because now I'm going more conservative in retirement. And what I might even do, first, just change it to 4% and make sure everything matches up. It does. Perfect. So let's go back to $300,000 distribution. And there we go. Taxes, net income after tax. And at $300K per year, how long does this last me? Until age 85. At this point in time, I'm out of money. Got a little bit of a balance, but not that much. See the chat box. Good question. No. So the question is $300,000 the RMD? That's just right after age 59 and a half. I'm assuming the couple wants to start taking income from the qualified account for retirement. So that's why I plugged that in there. I've got it at age 60, but I'm assuming 59 and a half. So what I'm going to do, just for the sake of this being on a recording, is go through the next tab, but at an accelerated pace, and then we'll open the floor to questions. All right, so we've got our salary with increases. So for the same case study, we've got an individual. He's presently making $950,000. That's his income today. What we have, tax bracket, 40%. That's his current tax bracket. Salary increase at 3%. This is adjustable. So for example, if he said, hey, I actually get a 5% increase every year, we could adjust it. If he is a partner at the firm, but says, hey, the increases are not consistent, I can make it 5% one year, 3%, then 0. We can be creative with that, which is nice. But let's leave it at 3%. So we see his salary increase over time. Then we've got contribution of salary, or contribution being a percentage of salary. Whatever we plug in here, it's going to take, if I have 25%, my salary of $950, 25% of that is this figure, $237.5, which my account balance is then $249 and change. The reason why is because I have a 5% interest rate applied to this account balance. $237 goes in over 12 months at a 5% interest rate, it will grow to $249 and change. If someone feels that's too aggressive, we can adjust that percentage, and you can vary it each year if you'd like, or just make it flat. I prefer it flat because it's simple, but we can adjust that. Then we've got income after contribution. This will be valuable as we look at the next two sections. So we see no contributions shaded in light blue, and then in purple, contributions with tax savings. So this is meant to give a consumer a side-by-side comparison. No contributions. If they said, forget it, I'm not going to do this qualified plan because I want access to my capital. At $950, that's your income today. At a 40% tax bracket, you've got $380,000 due in income tax. And I'll always throw in here, granted, I know you've got tax deductions and such. This is just based on 40% of whatever our salary is. But that's our income tax due, which is 40% of whatever the salary is each year. Compared to this, contributions with tax savings. So this is going to assume that you contribute money over here in light blue into this qualified plan. So if $237,000 went into the plan, that's $237,000 you do not need to pay in income tax this year. It brings your taxable income from $950 minus $237,000 to $712,500, which at 40% of this number, the $712,000, $285,000 in income tax due, which is a tax savings of $95,000 when we compare it to what we would have paid in income tax if we had not elected to participate in this qualified plan. And then we see year over year what things will look like. And if your tax bracket adjusts over time, we can change that each year too. So then we have the account balance as the years pass. If you want to take the traditional approach, what some people like to do here, say, okay, I feel I can earn 5% between now and age 60. And then at age 60, when I start to live off of this account, I'm going to put it in conservative accounts and apply a 4% interest rate down here. There we go. Over here with distributions, the tax bracket is adjustable. Let's leave it at 40% right now. If you want to take income, how much would you like to see coming out per year in annual income? I don't know. We can plug in 100K. Is that enough? No, we'll need more than that. We're used to living off this right now. Okay, I can plug in 250. If you think that's high enough. 350. Yeah, that's good. Okay. Ask questions and then follow up with the fact that we can adjust it. So whatever you plug in will be automatically populated from the years following. Before I go to each year and look at the account balance, I would do this: $350,000 coming out of a qualified account. What that means is the full distribution will be taxed as ordinary income. So if we're still in a 40% tax bracket, which, by the way, do you have other sources of income in retirement? I would ask that question if I don't know the answer to it already. If the answer is yes, they might still be in a 40% bracket. If that's not likely, we can adjust it. Let's say it's 35% because 350 is a chunk of change. 350 at 35%. Taxes due 122 and change. There's your net income each year. If we take 350 out and never increase that dollar amount, we run out of money by 82. You can increase that. If you said, okay, I'm going to start increasing it by age 65, we run out of money earlier. Ways to ensure we can pull out the dollar amount we want without increasing the interest rate, because I wouldn't do that, is by increasing the contribution. If you wanted to save more money. Right, but what it provides is just an interactive workbook that we can plug figures in and see for ourselves. I would play around with the calculator a couple times just to get familiar with the different options you can change and see the impact on values before presenting it or explaining it to someone. And of course, if you're going to show this to someone, I would mention this is what I do, is say, hey, this is something I put together real quick, nothing formal, not tax advice, right? Have all your proper disclaimers there, because it's not. What it is, from my end, is an attempt to put something simple together, because just throughout experience, when people receive reports that show here's your qualified account balance growing over time and here's how much you can distribute, sometimes it's overwhelming, especially if it's like 20 pages long. So this is an attempt just to show, okay, here's a workbook that fits on one page. I can adjust a couple different columns here, and I can see what my balance grows to. If I'm going to take income, that's what it looks like. I can adjust the interest rate, again, keeping it simple. Tax rate seems high, as there are several tiers starting with 10%. Am I wrong? No, so I know what you mean there. If you're going to look at the tax brackets, could be high. I mean, we could lower it too. That's why I always like to make it adjustable there. At $1 million per year, they're probably right around that, but we can adjust it. Any questions on this or the strategy as a whole? All right. What you could also do here, if you've got a client that's not making $1 million per year, but they're earning 150, not 15,000, Steve, 150. And let's assume they're going to work until they're 60. Trying to make it longer here. What I would do. There we go. So everything's here populated, or adjustments will occur for us, which is nice. 150, that total tax bracket is not going to be 40%. And we can adjust this, which is nice. Salary increase, they'll probably get one. So we can change this if we want. Let me do this. I don't want to mess this tab up for everyone. There we go. So 150, 20% tax bracket. Let's do a 3% salary increase. Actually, I've got to do this on the other option, the salary increase tab. Let me just do it here. Here we go. So one thing that I would look at for myself here is to say, okay, if I've got a salary of 150 now, yes, a 3% increase is the standard. However, do you think that people that work at companies ever feel that something like this is unrealistic? Like, is it really going to be a 3% increase every year? One would hope. You would hope, but that gets up there pretty quickly. A lot of times it's not the case. So have a discussion with your client there and let them know that this can be adjusted. Maybe it's 3% every other year, whatever it might be. Contribution of salary, make it 10% in this case, which is going to be more consistent with what we might be putting into a 401k as we get older, if it's a percentage of salary. You can also override the percentage amount by just plugging in a number, right? If somebody said, I'm paying in the max 18 grand per year, and that's what I'm going to pay into my 401k, you could just ignore this percentage column and just plug a flat number in. You could do that if you like that idea. I like the percentage because it makes everything flow. Interest rate, same thing, income after contribution, 135. The reason why, salary was 150, deducted $15,000. I've got 135 left over. Obviously, they're not going to be able to pull out $350,000. Close to 35K per year. All right. Any questions? I see one in the chat box. Cool. Before we move on to that, any questions at all on the workbook or make sense, guys? I can send this to everyone as well. If anyone would like a copy right after this call, can you include your email? Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.